So when you're comparing the digital ad market with the financial markets, you see some behavior in the digital ad market that simply wouldn't be allowed in the stock market. You would never allow a major investment bank to own the stock exchange and be the sole market maker in its own equity, as well as the leading broker to the equity in every other instrument traded on the market. And that's precisely the system that Google has in place right now. Now, there are some big differences in terms of the volume. In the exchange-traded stock markets, you trade 8 billion or so instruments a day on the NYSE and NASDAQ, and there's hundreds of billions of impressions traded in the digital ad market. And the stock market has individual shares which have a specific ID number on them with permanent value, whereas digital ad impressions are temporal in nature. But that notion of applying financial market regulation to the digital ad markets to bring more transparency is something that could be a very promising approach for regulators. The move from Google to obviate the third-party cookie or to bring it into a browser ID is something that has been well telegraphed in the industry, but has nevertheless sent many companies into a tailspin. And it's clear that there are many companies in the market that are relying on cookies which have been indiscriminately dropped on pages, and that will no longer be the case for their businesses. This is going to require a rethink of first-party data, either logged-in users for publishers or data that brands keep on their customers. And using that alongside third-party data, not necessarily cookies, everything from demographic or publicly available data, and turning that into an identity that can match what Facebook, Google, and the other large platforms have. And that is really where you need to see the next set of developments. Many of those data brokers that were trying to sell a combination of cookies plus other third-party data will have to rethink their business models.